What I'm looking at today is the psychology of trading. So I find this to be particularly interesting since Julie and I are both psychologists. Those of you who have seen us here before, you know the drill, or if you've seen us live someplace else, we are just long time professional equities traders and analysts. We've been, as Jeff said, Metastock partners for, it's got to be going on 20 years, I guess, and have had just a really good relationship with the software and what it does for the people we work with. And we love that because it helps to bring the things that we do to life. So that's been really cool. So everything that I'm going to talk about today is based on the stuff that you can actually scan for in the scanner, and it's based on the things that we do as traders every day with our own trading and our own analysis that we do, and also with the folks who we work with. So we've got a lot of people we work with from just over the years who are clients, who are boot camp survivors, guys who have come to our live events and trained with us and also are looking to be professional traders. We've been doing this since 1997. So our background is, we came at this, we were working on MBAs and PhDs concurrently at Claremont, and organizational behavior and a real focus on behavioral finance, which was a young field at the time, and just sort of looking at what is it that drives market behavior? What is it that drives, everything from very rational behavior to fear and greed in the markets, and how do we go through and profit from that stuff? So early on, I would say the insight that we had into this in the earlier 90s, 1995, 96, 97, was we got to work with folks from the New York Stock Exchange and dealt with specialists and $2 brokers, and spent a lot of time down there sort of figuring out, even at the institutional level, even at the professional trader, even at the floor trader level, what is it about what's going on in the world, what's going on in the markets that can really drive momentum, can really drive the price action. So today, I think we're in a unique position that, we've got a lot of stuff driving price action. You see it again today in what's going on with this surge in the market. How do you go through, how do you interpret that stuff? How do you figure out what's next, so to speak, in the markets? We're intraday traders. We trade strictly during the session. We open up here at 6:30 in the morning, so 6:30 until 1 o'clock. We are trading actively. 1 o'clock, everything is shut down, and all the ponies come home. So there's no overnight risk, and that's a very important component in our trading psychology. I've published a lot of stuff on all of this, including in Stocks and Commodities, which is, a great magazine. And, I should probably get back out there and write some more articles for journals and sort of the popular press, because, I enjoy it. I enjoy putting stuff out. I enjoy having people read about the things that we're doing. And, I think that the psychology of it is the thing that's most overlooked. So people really tend to overlook what's going on sort of between the ears, and that's really, where your war room is. And, everything that I've done over the last almost 30 years in the markets has emanated from this. So Around the Horn, A Trader's Guide to Consistently Scoring in the Markets, that was the book that I wrote that sort of defined everything that we do to this day. And that was originally called a multivariate analysis of covariance in the United States equities markets, heavily statistically modeled, put together in a way that said, what's the probability of X, Y, and Z? What given these inputs and given what's going on in the world, right? How can you go and account for, by looking at chart patterns, what is going to happen next in the markets? So when you're looking to covary something, you're looking for, how do you get rid of the effects of something? So like normal news, normal like earnings driven stuff, normal things that happen in markets just because that life happens, every day happens. How do you go and take those effects out and then allow for just a predictive model of what's going on with price? And, eventually we came around to it's probably not going to be the case that people want to go and drill down and do a statistical analysis of everything, but they do like to look at chart patterns. And chart patterns tell you just about the same thing, without having to run SPSS and Mankovas and all this stuff in the background. And that book then goes through and really focuses on market cyclicality. It's not in print right now. It'll be in print again later this year, a new version of it. But, as it focuses on market cycles and the human psychology that drive market cycles, I think that the patterns and the strategies that evolve around the patterns really manage to capture a lot of the upside, a lot of the potential in the markets, both on the long side and the short side, and put you in front of some really good opportunities. So, and that's the thing that Metastock scans for and does a beautiful job. So Metastock's scanner, the around the horn module, the plugin that they have for it, will go through and filter and find the opportunities, and then it's just up to you to go and select which ones are the best ones and set stops and targets and things. And if you play with it, I know they've got a great program, money back guarantees and all that stuff. If you play with it, you're going to find out that like the fastball setup or the infield fly setup or the switch hitter setup, those things can really get you out there in front of what's about to happen in the market before it happens. You scan for it tonight, and then you plan the trade for tomorrow, and tomorrow you just trade the plan exactly by the numbers. And I'll show you what some of those numbers wind up looking like at the end of the presentation here, because I think consistency is really the key to longevity in trading. Let me just tell you that, our show, which was a live broadcast show from from Television City in Hollywood, that kind of a thing, is now going to be an online show. As I mentioned, we moved south. We moved down to Orange County, to Balboa Island after the fires. We were lucky we had a vacation house down here. It's not really feasible to drive up there and go to a studio at 4 o'clock in the morning on the weekend to film this thing. So we're going to do it online. And Trader Nation is the name of the show. And it's a weekly show, and it does like psychology deep dives. So as we go and do things like interview top traders, we're also trying to go through and figure out, hey, what's the psychology behind this guy? What's the psychology behind this person that drives success? What's the psychology behind this person that creates obstacles, that makes somebody fear, makes somebody doubt? What gives them confidence? What gives them the courage of their convictions? And, it really goes through and tries to focus on what it is that makes traders tick. And with that, I'd like to say, if you have something that you'd like to submit and be featured on the show, you get a coffee mug or something, just send an email to adrian@traderinsight.com and let me know that you'd like to do it. And then what you're going to do is record something on your smartphone, and you're going to send it to us, and we're going to talk about it on the show and do a psychology deep dive. So we've had people who sent us questions about their propensity to gamble, right? A predisposition to gamble. We've had people who sent us questions just about, how do you stick to a trading plan? How do you avoid the emotions that go along with trading? And those are the kinds of things that we want to answer there. It's not really a show about, hey, what's Apple going to do Monday morning? Yeah, it's a show about how do I get consistent in my trading and get in front of the opportunities every day. So if you've got questions and you don't mind, being the featured guinea pig for the week, it's not hostile at all, I promise you. And I think you'll enjoy being part of it. Psychology is huge to us. I'll tell you, we've got this income trading boot camp. It's a mastermind program. It's a coaching program. It goes on a full year. We only work with 20 people. It's available as a streaming thing we're going to do it in Miami Beach again, June 8th this year. June 8th we'll be in Miami Beach. We prefer people are there live because the psychology of what's going on, again, is as important as you get a 650-page manual of stuff you're going through. You get 40 hours of online learning that you're going through. But then the 4 days that we're together there really wind up telling us a lot about the people we're working with and who we're going to be around for the next year. And they learn a lot about each other too, and they get to work through some stuff and find people who have sort of similar backgrounds as you go around the room there. I've got everything sitting in that room from a food photographer and a cop to a guy who was a professional gambler to a guy who owned a chemical company to attorneys and a farmer. And, it's like everybody brings something to the table. And what you bring to the table determines in large part how you're going to deal with the stress that the market hands you every day, or how you're going to deal with the stressors in the market, or how you're going to deal with and react to news events. How are you going to, interpret what's going on? How do you know when to use your hands as a seat cushion and stay out of the markets? There's a lot of different things that drive people's behavior. And, a lot of people come to this and they've been very successful in what they do. Everybody at that table, very successful. The guy in the black on black there, the third guy, and that's my son Connor. He's not a trader yet, but everybody else at that table, they came to this business as successful entrepreneurs. Right? I've got a guy who's been a commodity trader for the last 25 years. Putting on bona fide hedges. He's also a farmer, so he's doing real hedges in the commodities markets. You got a guy who's a market maker, a NASDAQ market maker. Now he's going to be an upstairs trader. They were all successful in what they did. And what they all have to get around is this notion of you get up and you have to go to work in the morning. And when you go to work in the morning, you have to work. And when you're working, you have to make money, right? Trading is very different. And a lot of it is about figuring out how you're going to deal with volatility. So right now, we've got a ton of volatility, obviously. What I'm going to show you at the end again is how if you've got a very stable system of checks and balances in place on your psychology, then it's very, very possible for you to be able to go through and make sure that even when the wheels are coming off the wagon, you're going to manage to stay in front of opportunities for profit. And I think that the key to all of this stuff is you have to understand the nature of volatility. So if you're a trader, if you're an intraday trader, if you're day trading the markets, if you're swing trading, volatility is your friend. If it's the right kind of volatility. The only reason there's opportunity ever, so we trade a lot of the Magnificent Seven stocks, we trade a lot of NYSE stocks to this day, right? We have a whole trading plan that is solely devoted to trading things that are on the New York Stock Exchange. We have a whole trading plan that's devoted to trading things that are only on the NASDAQ. We have a whole trading plan that is dedicated to trading volatility bands on sort of the super cap stocks. So why are there 3 different trading plans that we're actively involved in? Well, because there's 3 different kinds of volatility out there that you have to be able to account for. New York Stock Exchange, different animal. There's still a specialist system. There's still a system of price bracketing that goes through and sets up a different volatility profile than stuff on the NASDAQ. Stuff on the NASDAQ is going to have wider ranges, going to have more volatility over the course of the session. Those of you who trade lower dollar stocks that are sort of the high flyers of the day, the meme stocks and everything, why are you trading those? You're trading them because you want to get in front of that volatility. That volatility is something that you understand. But it's very, very important that you understand the volatility that you're dealing with and that you understand the difference between good volatility and bad volatility. Because good volatility is your buddy and bad volatility is going to be, the worst thing that you can step in front of. Because what's going to happen is even if things wind up going in your favor, wind up exactly where you thought they were going to, you're going to wind up stopped out of a trade because the volatility gets so extreme that, all of a sudden, I'm up, I'm down, I'm up, I'm down. Well, if you can just avoid those situations and you can distinguish between what's good and what's not so good, that's 3/4 of the game. as far as I'm concerned, because it's going to keep your psychology in check. When I say good volatility, I'm talking about stuff that's data driven. So I never trade a Fed day. I never trade a Fed announcement. So yesterday, I think it's on YouTube. If you follow me on YouTube, you'll see on the Trader Insight channel, I was talking about, well, here's what's going to happen after the Fed announcement. There's going to be a 1, 2, 3 whipsaw in the markets. And somebody said, well, how did you know this? And I said, well, we've known this for 30 years. For 30 years, we've had, pretty much, I could just put out the video from 30 years ago and say, here it is. It's a reactive kind of a situation anytime there's a Fed announcement, whether it's the calm voice of Alan Greenspan or the, somewhat panic-inducing comments that Powell can make now. Reaction's the same. And I stay away from it, even though I know it's going to be a 1, 2, 3 swing, even though, 90% of the time I'm going to see this pattern play out. What I know is there's going to be a lot of psychological discomfort that goes on for me because those swings are going to have me underwater at some point in my trade. I can almost guarantee it. You're not going to get the trade-off exactly at the right moment to have a profit from it, and you're going to watch this thing ticking against you. And how does that affect you, right? Well, how far is it going to go? Holy smokes! What if this thing, what if there isn't going to be a 1, 2, 3 swing? What if it's going to go down? If I'm going to be down $2,000, $5,000 by the time that it turns around and goes in my favor, or never goes in my favor? Those things are things that we avoid. What we like are predictable volatility movements. So, when there's earnings announcements, we know we've got our 2SD opening gap strategy. So some of you have taken that course. I know some of you guys are here today. And our mastery course on trading 2SD gaps is about one thing. We find 2 standard deviations of volatility, and we apply it to a gap in the morning. We look at it and we say, where does this gap put us? And what's the reason for the gap? Did the CEO of the company embezzle some money and he's sitting in a jail cell, or did he was in South America and involved in some crime? That's all happened, and he's sitting in a jail cell in Buenos Aires or something. It's all that's going to cause a distribution shift. That's not good volatility. Good volatility comes from things like earnings announcements, and we get a 2 standard deviation shift in terms of volatility in an opening gap, and then we know we're in the 95% confidence interval of the mean, 95% probability we're going to move back toward the average volatility. That's an opportunity for profit. These are the kinds of things that we teach our guys to look for. These are the kinds of things that we look for ourselves. Statistically reliable patterns that put you in front of the opportunity for a profit. When you get chaos, when you get unreliable levels in the markets, when you get these, sort of random tweets, random announcements that shock the market, drive price incredibly fast, then what happens is a lot of people do the coulda, woulda, shoulda thing. They're sitting there, oh my God, NASDAQ, look at this, 40 points, 50 points, or Tesla, or Amazon, or Apple, or, all the high flyer, they were really moving, and I could have been part of that. The reality is you probably wouldn't be part of it, or you'd probably get in the middle somewhere, because you didn't know when the news was going to hit. The news hit, you saw something happening, you jumped in, now you're part of the volatility, and now you get a lot of decisions to make on the fly. And I don't like making decisions on the fly in general. So I like things to be very much pre-planned, and I like to know what I'm going to do before I'm going to do it. So being able to capitalize on good volatility, knowing when to avoid chaos in the markets, that's what I think is going to keep you in front of just really good opportunities for profit. Fear in the headlines, geopolitical stuff, my worst enemy. So I don't trade any kind of, if we're talking, missiles, if we're talking tariffs, if we're talking, anything that's unpredictable that comes out of nowhere, I don't fool with it. So I also don't trade oil, and I don't trade banks. It's just my preference, because there's a lot of geopolitical influencers on those things. There's a lot of covariates, again, right? Mankova, the multivariate analysis of covariance. You have to figure out what you're trying to expel from your model so that you can figure out what's important and what's actually driving price. And 30 years in, I still can't figure it out for banking and oil and gas. There's just too many things: drillers, pipelines, oil services, right? Field services. All these things are impacted by lots and lots of covariates. I prefer to focus on things that are driven by a limited set of environmental data, right? Environmental stuff that comes in. When there's economic announcements, producer price index, consumer price index, run-of-the-mill stuff, manufacturing numbers, those things are very, very easy to account for. You know exactly what's going to happen in the market as a result of those announcements. We can go back, look at it historically. There used to be a great website that was like market history, and they gave you could do a look back and say the last time that producer prices came in at this level or this level of expectancy, what happened? Okay, the last 20 times that it came in, last 30 times that it came in. And you can build statistical models. Now, I don't know if they're around anymore. I don't think so, but you can still do that kind of homework yourself. And you can figure out, all right, if I've got this number coming out in the morning, what's happened the last few times that it was in line, out of line, met expectations, blew out expectations, and you can build a predictive model. Then you can go through and say, this is what I'm going to do in the morning if, right? If then. It's a bunch of very, very logical statements, so you're not guessing and you're not trying to read the chart on the fly. What you're doing is, I know what I'm looking for, and I know what the reaction move is likely going to be. If it does this, I'll do that. If it does this other thing, I'll do this other thing. You can prepare for this stuff, and you can get out of the way of the chaos. Not to beat this to death, but you want to engage with rational behavior. Think back to the exciting people you've known in your life. The exciting people you've known in your life have probably been the people who got you into trouble. Unpredictability out, life good. Unpredictability in, life bad. And it's the same with trading. So trading has a tendency to get chaotic at times. And if you can just convince yourself that what you need to do is take a day off, sit out the chaos, wait for the markets to settle in, wait for the markets to come to you, wait for rational behavior to return, then you're going to be way ahead of the game when it comes time to get in front of an opportunity for a profit. Some of what we do, as I said, is we trade the Magnificent Seven. And Magnificent Seven are, I'm going to say, they can be like your girlfriend's stocks. And you've got Apple, you've got Amazon, you've got Google. Those three are going to be very steady personalities, very understandable stocks to trade, great companions. You've got Meta and you've got Microsoft. They're a little bit more expensive and they tend to swing more. Now, they're not that far apart in price. Meta tends to swing much more. Microsoft tends to swing in smaller increments. Microsoft sort of stays in the boundaries, and Meta can have like big ranges and big true ranges that vary from day to day, makes it a little bit harder to understand. Tesla is a full-on borderline personality disorder. If you get Tesla on a day that Tesla makes sense, that Tesla is stable, where you've done your homework and you've said, this is the volatility that I'm expecting in Tesla, this is where I expect the volatility to be in Tesla, and if it stays within these ranges, I'm interested in trading it, then you're off to the races. You got a great day coming up. Elon Musk is a genius, but arguably none of us should have ever known him as well as we do now, because when he starts talking, the stock's personality changes. People don't know what to make of the things that he says. People don't know what to make of the opinions that he has. And it makes it super, super difficult to go and wrangle in a trade and make a trade that makes sense. It's just a situation where it requires some handling. It requires some skill. You need to have sort of a special psychology, a special skill set to be able to intraday trade Tesla, or even to position trade or hold this thing in a portfolio over a long period of time. You got to be cut from a certain cloth to be able to deal with the volatility that it's going to hand you. On something like Tesla, on something like, any of the Magnificent Seven, really, one of the keys to being successful is to figure out what's likely to happen after an event, after a chaotic event, after a big announcement. And, that's something I'm going to get into here in a minute on a chart and show you, how we handled Apple, how we handled Tesla after, a bunch of the geopolitical stuff that we had going on over the past couple of months. I'm going to focus on the tariff days. And these are trades that we set up with our guys. So all of our alumni join us in our war room every day, a Zoom discussion room where we talk about the trades that are coming up for the day. We put everything out there well ahead of time, entry, stop, target, and the list is posted. It's a spreadsheet. It's got things posted in yellow highlight if they're pending. And, when they're going to go live, yellow highlight, disappear. We all know all the time what everybody's planning to do, including days where we're going to sit it out and observe what's going on in the markets. So on the days that we had the big announcements, what we were focused on was we're just going to see where the inflections are. We're not going to trade any of this stuff. We're just going to get set for the market to come back into normal trading. Then, in the ensuing days, in the days that followed, what we did was identify the levels that we thought gave us clarity. We identified where patterns were starting to develop on the charts. And, in our trading, we focus a lot on pivot lines. We focus a lot on volatility bands that we deploy on the charts ourselves, where we'll sit down and figure out this is where the volatility is going to be. This is where it's, likely going to give us a profitable entry. This is where it's likely going to give us a profitable target. And then we get in front of those opportunities for profit in the following sessions. We don't do it when there's chaos in the market. So here's a prime example. So here's Apple. And you can see here that we've got some wild swings. So if you're looking at this chart, from the outside looking in, you're like, oh, these are great opportunities, right? This is an opportunity for, profit just because there's so much range on it. Well, look at the first bar, opens low, closes high, big red bar, because there's a lot of volatility in that bar, a lot of sell side volume in the bar that actually, made that upside move. It went from $192 up to $200. On a stock that normally has about $1 or $1.50 in range around the open that we trade. So, do we want to be part of these swings where over the course of the session, you've got better than $10 worth of range on the stock, but, you have to say, well, how much of this range am I able to capture at each one of these levels? And how the heck am I going to determine where to put a stop based on, what's been happening in these swings, where to put a target based on what's been happening in these swings, and how could I possibly predict where that final trending move was going to start, where we finally got the price action in Apple that we're used to getting. It's hard to manage these things when the worst of the impact is happening. Tesla, massive swings, right? $50 is the magnitude of the move. I'll move almost $35 right there in just the first few minutes of trading. And how in the heck are you going to go through, if you trade Tesla every day, then what you normally set up are bracket orders, or what our guys are normally setting up are bracket orders. We know what the typical range is. We know what the typical true range is. We know that if it gets into a pattern, then what we want to do is take profits with, say, $3 per share, have a stop loss that's maybe $1 or $1.50 a share. And if you set those same parameters on this day because you're used to setting them, you're dead. Because it's swinging so hard that what you need is good luck on your entry because your entry is going to take you straight to a profit target at, $3 away or whatever. And what you need to not have is any kind of adverse reaction that sort of tampers with your luck, because the tiniest little swing on the chart instantly stops you out. And I can't tell you how many people I've spoken to over the last 2 months who are like, yeah, you know what, we want to work with you because I don't understand how to time these trades on the news out of the White House. And they're very disappointed when I tell them, well, you know what, the timing of the trades when the news is coming out like this, when the tariff news is coming out, is to just step away and wait. Because what you don't want to have is a bunch of psychological damage that happens because of your decision making. What happens with extreme moves is you do wind up feeling like you got lucky if you make a profit. And you wind up feeling like you're an idiot if it hits a stop. You wind up feeling like you don't know what you're doing. And, it's very disruptive in terms of having the courage of your convictions going forward if what you just did was made a decision based on some headline you read on your phone, or something that blipped up on CNBC, and you decide, oh, I'm going to look at the chart and see what's happening, and all of a sudden you see the thing flying, and now you've got an emotional response to what's going on. I tell people all the time, this is not about emotion and intuition being guided by emotion. This is about counterintuition. You need to be able to look at the markets and say, successful speculation is the art of anticipating the anticipators. That's an old Bernard Baruch quote. And you need to be able to figure out what the psychology of the other guy is about to do to what's happening in the markets. And figuring that out requires that you don't have emotion in the game. So, if you can just wait until the volatility subsides and then go through and put together a game plan, right? By assessing volatility daily and by going through and saying, well, now, what do I think is going to happen tomorrow? You can get very, very logical about saying, all right, look, Tesla had a massive move today. And that move was driven by headlines. And I think that the headlines are going to permeate what's going on in the market for the next couple of weeks, but now it's kind of baked in. Well, how do I go and figure out where I should put stops? Well, what was the average true range of a typical 5-minute bar during yesterday's trading? Maybe I take out the headline shock itself, but I focus on the rest of that chart and I say, where can I really expect price to go, both in my favor and against me? And then, how do I say I'm going to be okay with what happens if I get in? I figure out the stops and targets, and then I'll say, do I really want to be trading 1,000 shares of Tesla, or 500 shares of Tesla, or 100 shares, or whatever my normal size is? Right? Maybe I want to cut it in half. Maybe I want to say, well, if I'm looking at this true range and my typical stop is going to be $1.50, and now it's going to be maybe $3.50 or $4, what I'll do is cut it down. If I trade 100 shares normally, I'll cut it down to 50 shares. Or if I trade 1,000 shares, I'll cut it down to 250 or 300 shares. I'm going to figure out what is a comfortable way to increase the magnitude of the stops without increasing the magnitude of the capital risk to the account. What it does for you then is when the next day's trading happens, it enables you to start being logical again. And logic is going to be the thing that gets you to consistency, and consistency is the thing, again, that gets you to longevity in the markets. You have to be able to, I don't care who you are, if you can tell me what your best year was, you've already got a problem. Because I'll show you in a minute here, I've had the same year going all the way back to 1997. It's just year over year over year over year. The results are pretty much the same. It's identical. And our guys are doing the same thing. And when you hear guys say things like, oh, 2008 was my greatest year ever because I was short the whole year. There's no way to predict that stuff. And there's no way to ensure that you're going to consistently be able to not just knock the cover off the ball and put up those same kind of numbers. But if you're doing something that allows you to focus on where the volatility is and where the volatility is likely to go, then, right, if you look here at this chart of Apple, now you got a different picture. So Apple opens the next day and it starts trading higher. Now we trade the open on Apple, that's a different strategy. And then we trade after the market settles in. So I watch for this next stretch of market behavior up to about 11:30 before I start making decisions about Magnificent Seven trades. What you see here is those red lines are pivot lines. So you just go to, in Metastock, if you're using the real-time version of Metastock, you're just going to you put an indicator on the chart. You're going to use daily trader pivots, floor trader pivots. This goes back to when most of us weren't using charting software, sorry to say, in the early 90s. And you would just calculate these things. The central pivot is yesterday's high plus low plus close divided by 3. And then you get S1, R1, S2, R2. You can even go S3, R3. And we're looking at now levels of price action. Those blue lines there are the volatility bands that I've created based on previous day's price action. The red lines are the floor trader pivots. We also look at volume weighted average price. We look at anchored volume weighted average price. We look at a bunch of things, but this is the essence of it, right? So this is where do we think price is going. So if you look at the blue lines, those are my anticipated inflections. Look at those red lines, those are pivot lines, and look at what happens when we come to that first anticipated inflection, which overlaps with a pivot line. After a trending move lower from that pop higher in the morning, now we get this extension move all the way down to our next anticipated volatility band, the blue line. So we drew that. That's not generated by Metastock. That's generated by us having gone through and picked apart volatility in Apple. Where do we think the volatility bands are going to be? And look what else is there. Right. So now you've made a move down to a pivot line. That pivot inflection is where we're saying that's a good opportunity to take a profit off the table. It's a pretty significant profit. You've made a move from $185 down to about $178 per share. And that's a nice opportunity for profit. And there's places on the way that we can also scale out of the position and take incremental profits. And we're doing it because we know exactly what we're going to do before we do it. It gives us the courage of our convictions, and it makes us feel like there's a reason we're doing the things that we're doing, as opposed to just, oh my God, it's taken off without me, and I've got to get in on this. Then it moves down to our next anticipated inflection point. That's our next volatility band that we created. And then look at that. It moves up to that pivot that we just got out at, gives us another opportunity for a short, and makes a move right into that next floor trader pivot going into the close of trading. It doesn't have to be rocket science, right? You don't need so many indicators splayed all over a chart that you can't even read the chart. What you need is good, solid logic that tells you this is why you're doing what you're doing. And right, here's our borderline personality. Here's Tesla. So Tesla comes in that next day, and sure enough makes a big extension move higher. You're up 20 something bucks, and then starts doing the same behavior. Tesla tends to move on its own. It tends to be a little less correlated to what's going on in the broader markets for obvious reasons, right? Again, we probably shouldn't know him, but once it starts making moves in the bands, once it starts making moves inside the pivots, you've got a very high probability that you can get on the right side of the position, right side of the trade. So it goes up here and it tags that upper pivot line. And, again, I'm just looking for it to do something that I can identify as trend-based going into like the 11:30 time frame. That's where I've got my sights set on boxing up. So if you guys watch, if you go to traderinsight.com, there'll be a pop-up there for my daily strategy sessions. I get on the Trader Nation stuff. I get on Trader TV every day and talk about here's where I think the Magnificent Seven stocks and the triple Qs and the spiders, diamonds, all that stuff. Here's where I think the opportunities are going to be. It's based on this kind of analysis where I'm going through and I'm saying, well, at 11:30, what's the directional move that the market's making? And then am I getting a pattern move in the stock? So if you have the meta stock scanner, then right, you should recognize that little bar that we moved up to there. That's an infield fly bar. So that infield fly bar gives us a very strong indication of a reversal. So in our war room, in our Zoom room every day, the guys are all looking for infield fly setups. This is the only reason we're all there, is just to, keep each other in front of the opportunities. We're not trading penny stocks. We're not trading, options. We're trading some future stuff based on the Qs and the NQ. We're trading some ES based on moves in the spiders. But we're looking at the charts and just trying to keep each other in front of these opportunities for success, these opportunities for profit. Infield fly bar, where is our target? It's going to be down at that next pivot line. If it gets, which is right below, right where the price moved higher from, we got up into a support and resistance level. We got up into a volatility band, set up the pattern. The pattern is one of the very, very highly statistically reliable patterns from around the horn. We know that. We know that, infield fly is a favorite. And, once it goes, it really goes. It gets us down to that first pivot line. If we got out there, that's great. That was our target. That's fantastic. If we waited for the next pivot move lower, then we got out, when it got down into that next threshold level down around $237 a share. Picks back up again, bumps into that pivot from below. We've got a sustained downtrend. We've got the move into the pivot. The pivot is a place that we're expecting price to react. There's another opportunity for a short. And in this case, the short gets us right down into that next level of volatility that we were expecting to see, hits that next volatility band that we planned for, that we anticipated was going to be an inflection. And if you got from the pivot down to that level, you got another opportunity for a profit. And again, you're scaling back on the size on these trades. They're not $10,000 trades. They're not $1,000 trades. Probably they're trades that you've gone and made comfortable by limiting the risk based on the range that you're seeing on these intraday bars. Now you're back to your typical day, right? You've made the adjustments so that nothing is going to be outsized. You're not going to have outsized gains, but you're also not going to have an outsized loss that goes and wipes out your psychology. You've got another move lower after price came back up to the pivot, gets you down to the next pivot, down to the next volatility band. All these levels that you've identified ahead of time are there and telling you what price is likely to do next. It's much more to me like trading is very much like music, right? There's a rhythm to it. There's a pulse. Right? If this is an analogy you're more comfortable with, I use things like the volume weighted average price to tell me, am I on the right side of the market? Is the market trading above the VWAP and likely to revert down to the volume weighted average price? Volume weighted average price is where institutional traders are being rewarded for the trades that they put on. So it's very natural that you're going to expect to see price move back to that VWAP. Are we trading below the volume weighted average price and likely to have a pullback up to the volume weighted average price? Where is that in relation to those volatility bands that we've identified on the chart? Where is it in relation to the pivot points that we've identified? And then what does the true range because if the true range on the chart, if the average true range for the last 10 bars is going to be $2 or $3 and you're setting your stop at $1, you may as well just give away the dollar. Just flush the dollar down the toilet, because the market does not care how much you'd like to make or what you're willing to lose. It's all about what's happening. What are the dynamics that are driving price, and where is price likely to wind up, either in an adverse move against you or a positive move that goes in your favor. It's not going to be determined by what you're comfortable with. It's going to be determined by what the market's been doing, what the market's natural reaction range has been over the course of the session. I think everybody, I tell my guys all the time, you take a look at what you're doing. You take a look at what you're not doing. Did you get to a price inflection that you had a trade planned for and then make the decision not to take the trade? Did that just happen to be when you got up and got a cup of coffee, or decided you had to stretch your legs, or get away from the computer for a while? What is it that made you decide not to take something? Or was there pending news, right? Was it a logical decision, or was it, oh, I'm afraid that if I get into that position, I'm going to wind up losing $4, so I'm not going to take that position. And then you get back and, oh, it went to my profit objective. I would have wound up making $8. Oh, well, what I need to do is write down and tell myself, even 30 years into doing this, you know what? I didn't want to lose that money. And instead of scaling my position way down, I just decided to walk away from the computer. And now I feel like I don't know what I'm doing. So keeping track of these things is super important. We tell all our guys, send us, well, like the videos, right? Send us a video of yourself, or send us a note, and let's stay on what it is that is putting you in front of opportunities or preventing you from capitalizing on those opportunities. And if you find yourself in a position of, I feel like I just made a bunch of mistakes, you need to go through and reset. Right? It's not time to throw the computer out the window. It's not time to set the whole thing on fire. It's time to just say, you know what? I didn't do what I planned to do. I didn't do what I said I was going to do. And I need to figure out why I didn't do it. Because it's not really about, ultimately, it's all about, are you making money trading? Are you not making money trading? But the reality is, it's about whether you are able to follow a plan consistently. And that's what's going to determine, right, whether you've got a long-term edge in the markets. So, again, go through, isolate the two kinds of volatility so that you know what it is that you're looking for and you know what it is you're looking to avoid. Use your tools, get in front of this stuff and say, I need to go and make shifts in my position sizing. I need to make shifts in the days that I'm going to be in front of the computer based on what's going on in the world. And most importantly, I need to keep track of those decisions and focus my energy on being able to stay psychologically successful. I need to be resilient. I need to be, adaptive. I need to have a growth mindset. I need to be able to go through every single day, assess what I'm doing objectively, not be hard on myself. You don't want to beat yourself up in trading, because we've got this tendency come down pretty hard on our mistakes and to feel like winning is winning and losing is losing, and winning's great and losing's bad, and if I lose, I'm bad, right? And I'm a failure, and if I win, everything's great. And then what will wind up happening in your trading is you take smaller and smaller gains in order to keep being profitable, or in order to book profits. You wind up taking larger and larger losses because you want to avoid that bad feeling of losing. So ultimately, my whole thing comes down to, I want to be consistent. I want to create a group of consistent traders. I want people to be able to go into the market and find the rhythm of the market and know when the market is behaving normally, and how it is that I can get in front of those things that are, quote, normal, and how I can stay away from the days that the market is exhibiting some, it's a bad actor, bad behavior, bad stuff going on. This is not for, this is for maybe some really deep pockets out there who don't mind taking a giant bet on a big swing, but it's not for me, right? So I've got to go and stay on the sidelines, and I'm going to come back in and make sure that I've got some stable results as I move, my business through year after year after year of market behavior. I want to show you this. I mean, this is this year. And, you can see that, the equity curve on top there is flat because, we haven't got into the end of the year yet. It's just the way that this is charted. But if you look at this, there's a couple things to bear in mind. So January, we would have had a light trading month anyways because of the geopolitical stuff that goes around having an inauguration and having all these expectations and things that people think are going to happen in the market, things that, reactions to comments that are being made. In addition, I didn't have a lot of trades out there in January because my house burned down, right? So my stress also affected my trading, in that I said, I'm under too much stress, trying to get my family relocated and do all this stuff, to go and say, I'm going to trade whatever situation I've got going on right this time. I'm just going to get in because I've had my guys were like, my guys all said, geez, well, not all of them. You're so lucky that, you can just pack this thing up, take it on the road. And, it doesn't even matter. This thing would have shaken people up so bad and you could just sit down and start working again tomorrow. No, I had to get my head back in the game. Just like when the market's chaotic, the market has to get its head back in the game. Look at what's happening in this equity curve, though, as the year is developing, and then look at what the equity curve looked like a year ago. This is a different market, right? So this would be during Biden. The numbers are the same, right? So if you look back to May, you see that for this time of the year, 2025 looks pretty much like 2024. Then go back and look at, this is 2017. Look at May. Again, we're pretty much the same place. It's consistent. We're getting in front of consistent opportunities for success. You can look up top there. Those are all the patterns in around the horn. You can see how they play out year over year, right? We can go back again and look at, the overall profitability. Shorts to longs. Shorts have been big winner. The shorts have been a great place to find opportunity in the markets. The long to short ratio says that's where the opportunities were spotted. So when we went through, if you went through and you did the scans on Metastock, it's telling you, all right, there's more opportunity on the short side of the market, more opportunity on the short side of the market, more opportunity on the shorts than the longs. And over time, when you look at where the profitability was, it says, yeah, we're not skewing things. We're not letting the psychology of, somebody doesn't like to get short enter into the decision about how to trade. What we're doing is looking at this logically and saying the opportunities are in one place. The profitability tends to be in the same place. I'm running my business like a business. I'm getting in front of opportunities without letting my psychology impact what's going on. That's the name of the game as far as I'm concerned, is getting a system in place that works for you, that gets you in front of the opportunities every single day that there is an opportunity, keeps you away from the threats when the volatility says stay out of the market. And, if you can just wrap your head around that, and if you can wrap your head around psychologically, if you can say to yourself, what, just because I go to work every day doesn't mean I have to be at the computer all day long. I can assess what's going on and just say, what, time to step back, time to step away, let things settle in, and tomorrow I can come back, I can have another look at it. If you want to join us, if you want to come in and see what we're doing and look at the trading plans and all the blotters for all the trading plans, so not just those results that I showed you, but everything back to 2006 is on the site. You can pull up every single trading plan, look at it, run your Metastock scanner for tomorrow, then go through and look at the trading plans that I'm publishing for tomorrow. You've got access to all that stuff and say, okay, of the stocks that Metastock scanned, of the stocks that came up on the scanner last night, which ones did Adrian pick? Which ones did he put on his trading plan? Why did he select those particular ones? Why, out of the group that Metastock put up there, how did he pick the stop? How did he pick the target? And then what's the result? It's a really good place to sort of hone your skills. It's a really good place to learn a bit about what we're doing, and maybe if what we're doing is for you. traderinsight.com/trade. You just come in for 2 weeks. There's no credit card or anything. You can just take a look at what's going on. If you're trading intraday, there's a good chance you'll want to stick with us. You'll want to do the bigger training that we do, the boot camps, and some of the as well as some of the online courses. And in the meantime, if you've got questions, if you're watching the recording of this and you have questions, you can send me an email, adrian@traderinsight.com, or you can send me a text at 310-804-2248. And just let me know you want to talk, and then we can just do a phone call. So just add that number to your phone book, Adrian. That way when I call you back, you'll know it's me, and you'll take the call. All right, so that's it. That's all I have. I barely left any time for questions, I guess, as usual. But if you have something, I'd be happy to answer. And if not, then I'll let Jeff take over and move on.